Good morning, everyone, and welcome to another edition of Decipher with Dezerv. Today is Saturday, the 21st of February, 2026. I am Kushal Karkare from the investment team here at Dezerv. I work on portfolio analytics and market insights. And thank you very much for taking the time out to join us here on a weekend. We truly appreciate it. The timing of today's session is quite relevant. Over the last few years, equity markets have seen sharp rallies, sudden corrections, long periods of consolidation, and a lot of noise in between. Every phase tends to bring the same set of questions from investors. Should I start now? Should I stop my SIP? Should I wait for a correction? Or should I increase when the markets are high? And ironically, these questions don't change much, even though the market environment keeps changing. Which brings us to the core theme of today's session. Today is not about predicting markets. It's not about the next 6 months, 1 year, or the next 5 years. Today is about SIPs, not as a product, but as a core behavior. About how small, consistent actions taken over long periods end up creating disproportionately large outcomes, and why most investors still struggle to stay consistent exactly when it matters most. We'll decode why SIPs work, what the data actually says about timing, frequency, and step ups, and how investors can use SIPs not just to invest, but to stay disciplined through different market cycles. Joining us here today is Prateek Bagaria, the Principal Officer for our PMS business here at Dezerv. Prateek oversees how portfolios are constructed at Dezerv, how risk is managed across asset classes, and most importantly, how investor behavior is kept in check during both euphoric rallies and uncomfortable corrections. With over 20 years of experience across market cycles, he's seen firsthand that long term wealth is rarely built by making perfect market calls, but rather by far more often sticking to a process, especially when emotions are running high. Good morning and welcome, Prateek. Great to have you with us here today.
Morning, Kushal. Morning to all the listeners.
To take this forward, in investing, we often overvalue speed, size, and what we've seen across investor behavior is perfect timing. But markets reward something far more boring, which is consistency. And SIP is simply consistency made automatic, and it's a do it once and forget about it and see you reap the rewards over a long period of time. And to explain why consistency matters, let's step away from the markets for a moment. So, what we have here on the slide are two images of natural wonders, so to speak. The one on the left is an image of the 12 apostles from Australia. Now, what can be seen from this image here and is highly evident is that we can see certain broken masses floating on the water, right? But take it back a few hundred or thousand years prior, and this would have been one long contiguous mass of body, right? Over the long period of time through the natural wave action, small consistent motions, humans have managed to break down this mighty mass into small pieces. Much like an SIP, this has broken down this entire thing into something far greater than it actually is. What the point we're trying to make here is small, consistent efforts, much like an SIP, can reap massive benefits over a long period of time. Again, the operative here word here being consistency. Again, the image on the right here is the Benegil Sea Cave from Portugal. It used to be one large mountain with not much of a beach, as you can see here today, not much of a tourist attraction. But again, over the years, through consistent hammering, small inroads made by these waves, we can see how this has created a nice natural beach. And again, linking this back to our SIPs, it's through the power of consistency and small efforts, we've seen them reap huge benefits. Prateek, if you could move to the next slide, please. Yeah. Now, coming to what is an SIP, right? Most of us are familiar with SIP, mutual funds. We keep hearing about this through various avenues, be it through advertisements, through mutual fund distributors, through wealth managers such as ourselves. But what is an SIP exactly, right? It's a systematic investment plan through which you can consistently invest money into the markets through an automated fashion, be it over a month, a week, or even a year. Now, what this allows you is rupee cost averaging, right? Now, what I mean by rupee cost averaging is that you get to buy more units when prices are low, as we've seen over the last 12 to 18 months when the market went through a long period of correction followed by consolidation. There was a golden opportunity for investors to accumulate a lot of units or shares of quality businesses at far lower prices. And secondly is flexibility and convenience, right? You have the option to start, stop, or modify these systematic investments as per your financial goals. Now, it might be something as simple as a holiday fund. Maybe you have a plan to go overseas a year from now. You can start a small SIP and make sure that enough money is allocated, it grows to a sizable amount over the next year or so, which can contribute significantly towards your goals. Pratik, can you move to the next slide, please? Now, how does all of this look in an Indian context, right? If you take it back all the way to FY 16-17, the SIP flows in India stood at about 43.9, sorry, it's at 3.5 lakh crore today. You take it all the way back to 16-17, it was 439 billion, right? Since then, it has grown multifold. If we see over the years, small incremental gains has been seen. We saw periods of lulls in 1920, 2021. These were periods when the markets were flattish. We saw sort of a bearish return across markets. And then post COVID, we saw an explosive boom in this SIP. And this has not stopped, even though we've seen the markets go through a long phase of correction in the last 18 months. In fact, this has gone from strength to strength. And as of this current financial year, we're on target to hit 3.5 trillion rupees in SIP book for this year alone. So this scale of this growth has been massive. Now, how does this translate through something that is more relatable, right? All of these companies on your screen, which are marquee names that most of you would have seen, interacted with, or even avail of their services. Things like Bata from buying footwear, Colgate, a toothpaste that most of us consume every day. Now, this 3.5 lakh crore SIP book would have enabled you to buy up shares of all of these companies on your screen in one financial year alone. So, if you think about it and zoom out a little, that's how massive the scale of this investment is. Uh, Pratik, anything you'd like to weigh in? How do we think about this? Just the sheer scale of it is mind-boggling.
Yeah, so it's become really humongous, right? Almost 30,000 crores of money flowing into the markets every month from retail investors, large enough to give FIIs exit. And as you mentioned, by those 15, 18 large companies also. But so yeah, it's grown into massive book, and this is because people have over the time experienced and realized the benefits of that. Uh, Over here, I have three funds: Franklin India Flexi, HDFC Flexi, and Nippon India. Primarily because these have a long history. So if we see somebody doing a 2000, somebody started with a 2000 rupee SIP and staying at that 2000 rupees SIP consistently for 30 years, they could have made as much as 5 crores over that period of time. So yeah, the benefits, the scale, everything over there is just uh, very counterintuitive to absorb.
So, I mean, just to put this in context for the larger audience, something as small as 2000 rupees which most investors could have afforded to invest even back then, 30 years
30
ago, has
years.
ballooned to something as sizable as 5 crores. Or even if you look at it in the context of the first fund, they're 2.8 crores, which is a massive, massive amount.
Yeah. Somebody starting their careers 30 years back, right? They could have, even those people would have been able to save around 2000 rupees a month and put it in a SIP.
So, I mean, before we get into the nitty-gritty of it, I'm sure this data is very stark and surprising. What usually breaks SIP journeys before they reach outcomes like this? Because I'm sure not most investors would have seen this right through.
Mm, Behavioral aspects are the ones which usually breaks the compounding. As you said, towards the start, right? It's not the size, not the speed or strength. It's the consistency. As long you are consistent with it, it generally does not break. But if mostly it's the consistency, the behavioral issues that creep in, and people suffer. Another issue would be that the selection of right funds. While we are seeing three good funds over here, there would be obviously some survivorship bias. Maybe there could be some certain funds which are not as good and would not have delivered if you just kept on investing in those funds.
Got it. And there's other ways also, right? You could have had an affluent investor who invested a large amount of money 30 years ago. But how do you uh, put this in context of an investor who consistently invests over the years, that even though you were late to the party, so to speak, you have not missed out much?
So you should look at it. So I've plotted a graph here, right? Now it tells you that how much of an SIP is equivalent to a lump sum. Okay, so let's say 1.5 lakhs of SIP for 20 years. So let's say if you're going to do the SIP for 20 years for uh, so for 1.5 lakhs, right? That is as good as 74 times of lump sum. That is close to 1.1 crores.
Yeah.
So if you do a SIP of 1.5 lakhs today for 20 years, or you put 1.1 crores lump sum in a fund today, the results in both would be the same.
Right. So, I mean, this looks large for an amount like 1.5 lakhs. But if you could just quantify this for something like a 5,000, 10,000, would this also look just as large in that scale as well?
Yeah, so even for something like 10,000 rupees, it will be to the tune of 7.5 lakh rupees worth of lump sum invested today.
Got it. Uh,
If you
and
do it for a smaller period, let's say for 10 years, then it will be 55 times. So roughly 5.5 lakh worth of lump sum today.
Got it. So, I mean, a few ancillary questions to this. Despite this data, most investors still wait for the right time, right?
Yeah,
So, is it fair to say that SIP is more about minimizing mistakes rather than maximizing returns?
absolutely. Maximizing returns again, also to an extent, is a factor of markets and the kind of people you have bet on, right? Beyond from your end, what you can control is minimizing your mistakes that you can incur during the journey.
Got it. And is there any way to increase these returns? Like we mentioned, someone started an SIP of 2000 30 years ago or invested 1.5 lakhs a month. Like what happens when there's career growth, there's income growth, you have the means to invest more,
Yeah.
disposable income grows. How does this look in that context?
So that's a very practical scenario, right? As we said, that somebody who started their career 30 years back and kept on investing 2,000 rupees in, let's say, Nippon India Growth Fund would have made 5 crore rupees. But also we need to factor that this person's salary income will not remain stagnant. Over the 30 years of their career, they will keep on experiencing pay hikes, etc. If we assume a 10% pay hike, right? Even the expenses bit can go up 10%, but even the savings bit, if they match up 10% and the person is able to do a 10% hike on their SIP, Instead of 5 crores, they would have amassed 8 crores worth of portfolio over these last 30 years, which is a good 60% higher than doing the SIP without step up. So step up like really puts the SIP on steroids.
Right. Uh, so if investors could improve just one thing, what matters more, starting early or stepping up?
Both have their own. Ideally, you should do both. That will yield the best outcome. If you are starting late, then step up could be a good way to catch up with for the amount of time that you've lost.
Got it. And like we see sometimes we see influencers, lot of publications out there that show just these numbers but with far higher step ups, right? 20, 30, 40%.
Yeah.
What do you think is a sustainable number here?
See, it also depends on what phase of life you are in. Towards the early part of your career, stepping up too much will be difficult because the salary base is such that a lot of it goes into necessities. You have commitments growing. You'll buy the first car. You'll get married. You'll have kids, etc. But after a period, your expenses stabilize. Once your kids are in school, you understand, and the base of your salary is higher towards the later part of your career, and on that, any kind of an increment mostly goes a larger part of that goes towards savings. So, as so initially the step up could be small, around 10%, but towards the later stages of your career, you can target maybe a 10, 20% step up.
Got it.
I'm
And
talking about somebody who is still growing stably in their careers.
understood. And another question that comes to mind is about timing, right? We see a lot of people question, should I invest on the first of the month, the
Yeah,
second of the month, the 15th of the month, the 30th of the month? Should I
yeah.
go stagger my investment across a month, a week, a day? Like, what is the ideal thing to do here?
So we did all those analysis just to break this myth, right? Now, here we have showed an example of a person doing an SIP on first of every month for the last 20 years. The SIP amount is 20,000, sorry, 25 years. So SIP amount is uh, uh, 10,000. They've invested this for 250 months, let's say. So 25 lakhs of invested capital. The current market value of that would be 1.23 crores, 1 crore 23 lakhs. And the IRR sits at 13.48%. Now, let's say this person instead of first decides to do the SIP on 15th of every month. The result is very, very similar. The IRR is almost identical at 13.548%. The current market value also sits at 1 crore 23 lakh. The difference is to the tune of 60,000. Now, in an investment of or a portfolio of 1.2 crores, 62,000 is not an amount that you will break your head over, right? And that too, you
Correct.
don't know goes which way. Maybe first could have turned out better or 50. Now, if we look at 25th of the month, again, the numbers look very same. You would have made 1 crore 23 lakhs, 23,000. So that is maybe 40,000 lower than starting it on first of every month. IRR turns out to be slightly higher because you are investing late, but a very marginal difference. Broadly, is 13.5% return for uh, all the three dates. So nothing much to take away from there, right?
Right.
These returns could have been anywhere. Any one of these dates could have been higher or lower depending on when you are looking at the data. Second, you said about the frequency. So the most followed frequency till now was or is monthly frequency, where a person invests every month. And obviously, it's the same scenario where you are getting 1 crore 23 lakhs, 64,000. Now, if you are hyperactive and you want your SIP to go in weekly, first of all, you'll have to divide your amount from 10,000 to 2,300 so that you are able to invest the same amount every week. The in Final amount again comes to 1 crore 23 lakhs 20,000, a difference of 40,000 rupees.
Right.
If you do that SIP on a daily basis, you will be investing 330 rupees. And the final amount comes again to 1 crore 23 lakhs. So again, daily, weekly, monthly does not matter much. In fact, I believe monthly sits better with your salary cycle or your income cycle. Then that is what you should opt for, because having a daily SIP going in very difficult to track, keep account, and even at the time of redemption, you'll have to ensure that so many transactions that have taken place in your account, you are factoring in all of those before making any switch or redemption decisions. So it will definitely add on to your hassles if you increase the frequency too much without adding to the results.
Understood. Got it. Uh, I mean, this is really powerful stuff.
Yeah.
What we're trying to say here is again, consistency matters. It doesn't like timing. It doesn't really change your outcome significantly. But one question comes to mind, like where do discipline and decision making collide, right? At what point do you say this is not working in context of your fund selection or your asset selection? At
Hmm.
what point do you say that now is switch, or does it not matter? Like, do you just stick with what you've picked and stay invested?
So one should be looking or monitoring their mutual funds closely and switch when required, right? So, for example, I have this data from 2013 Jan till Jan 2026, where I've taken the example of Axis focused fund, right? So let's say somebody started an SIP of 10,000 rupees in on 1st Jan 2013 in Axis focused fund, and they kept on doing that until now. They would have invested for 157 months, so that's why the investment amount comes to
Mhm.
1 crore or sorry, 15 lakh 70,000, and the current value of that portfolio would have been 37 lakhs. But had you realized that the growth style or the quality focus uh, of that portfolio is not anymore in vogue, or it's the market is moving against that style? In fact, value style is what where the money is being made, or in any of these years, right? 2020,
Yeah.
let's say if you realized that early and moved on to HDFC Flexi Cap, you would have made and sold your Axis focused fund and moved to HDFC Flexi, plus shifted your SIP also to HDFC Flexi. Then your current value would be much higher at 61 lakhs, which is a good 24 lakh higher on a investment base of 15 lakhs, right? So that is a much favorable outcome. But you can say that, okay, this was too early to identify that, okay, access will or the quality is fading out and value will do well. But you could have done the same thing in 2021 and 22. Still, the outcome would have been equally favorable. You would have made 69 lakhs or 64 lakhs instead of the 37 lakhs that you made by staying put in HDI, your access focused fund. This is just an example. While I'm taking the name of the funds, I don't mean that our outlook is the same on this fund right now. This is just a historic example from the history to explain that how a simple switch from a non-performing fund to a performing fund could have a big impact in your portfolio.
Got it. So just to digress a little from what is evident in this chart, you can see that Axis Focus, the quality line, is more or less in line with HDFC Flexi Capital about 2021, right?
Yeah.
So how does one even go about identifying that now the tide has turned, maybe it's time for a new fund? So how do we at Deserve help people identify this?
So we have a framework called FAST, right? One thing that you should not definitely do is you should not do is look at the past performance. We've done those simulations also. If you pick up funds with good past performance going forward, it's not necessary that they'll continue with that performance. So we have this framework called FAST, FAST. F stands for fundamentals, A is for allocation, S is for skills of the fund manager, and T is the macro trend, what sort of a macroeconomic scenario we are in. So you need to look at all the four things holistically, and then accordingly pick your funds that, okay, this fund is expected to do well, this might not do so well in this cycle, and look at them in an unbiased manner. So you don't pass judgments on a style of a fund manager saying that I will never buy this or I will always buy this. Instead, you see that what the current trend, and the current portfolio of the fund manager based on the current fundamentals, allocation, etc., who is more likely to deliver alpha going forward.
Got it. So, I mean, all of this looks great looking back at the past. Can you maybe contextualize this in context of an actual investor, or how do they behave across market cycles?
So even as I said earlier, right, the reason that the SIP book in India has grown to 30,000 crores is because the investors have actually realized the benefit of SIPs. However, they continue to make the same behavioral mistakes that they have been making for a long period of time. Thankfully, or we have access to this data, a lot of data from individual investors. I managed to pull out some data, and I found this case study pretty interesting. Whereas this is a single investor. He started with a SIP of just 7,500 rupees in 2011, and his portfolio value has grown 500 times of 7,500. It's roughly 75 lakhs now, right? And pretty consistently up till 2017, he kept on investing every month through SIPs, right? To a
Right.
point that he took his SIP figure to 4,81,500 for the entire year in 2017. But that is when things started changing. From there, again, he started reducing his SIP amount, and by the time the bottom of COVID hit, he was somewhere close to 1,55,000 or 1,56,000 of SIP per annum. So the entire period where the markets would have given him an opportunity to collect units at a lower price, he kept on stepping down instead of stepping up or even staying put. After the markets rally, this person again increased his SIP. So sort of chasing the market behavior is what we say. Then we try to see that is this behavior replicated in other portfolios as well.
Right.
And we found that yes, this is not a secluded example. There have been a lot of investors who have, in general, made good money in SIP, but because of these behavioral issues and some of them not picking the right funds at the right time or not moving out of the, a fund would have given you phenomenal returns, right? But like for Axis Focus, for example, we spoke about, it gave you phenomenal returns till 2020, 21. But there is a time that you move out of that fund and say that, okay, this may not do well going forward, I have to change my boat. So because of those issues, investor could not make fully optimal returns that they could have achieved otherwise.
Got it. So, I mean, it's very clear looking at this chart that
Mm.
when the markets had been during a lull phase, 17, 18, 19, the investor began to step down,
Yeah.
all the way down to the COVID crash. And then once the rally was realized, there was
Yeah.
a massive step up.
Even now you can see, right, in 2025, markets did not do too well, and the SIP amount, instead of increasing for the last 3 years, this year again it dipped slightly, but it still dipped by roughly 7,000 bucks a year.
So, I mean, this is very interesting, and I mean, it's basic human nature. But any advice on how you remain consistent? Because this is a trend, like you mentioned, we've seen across investors. It's easier said than done. But what is one thing that you would urge investors to do to stay invested?
So these kind of behavioral biases, issues, plus checking what the funds will do, having a framework in place for taking your financial decisions, plus doing your full-time job so that you can earn to invest in these SIPs is sort of uh, close to an impossible task, I would say. The best thing is to actually rely to your on your financial advisor, have somebody Could be anyone, but obviously someone you can trust during the and someone who understands the markets, obviously. Uh, you need somebody to handhold, right? Like in Hindi, you always say that you need a guru.
Right.
Similarly, there in financial industries also, or financial markets also, you need somebody to handhold you through these periods. That's one way of dealing with this. Other way is the hard way, where you just accumulate all the knowledge, give enough time to all the research, etc., and do this, which some of the full-time investors also do, and pretty successfully.
Understood. Another question comes to mind. We've talked about SIPs remaining consistent. However, looking at this from a holistic portfolio approach, everyone will have an asset allocation that has been structured.
Yeah.
How do you ensure that an SIP rebalances that to its predefined levels?
Yeah, so that's the beautiful thing about SIP, right? Without selling anything from your mutual fund portfolio, you can use the SIP to rebalance your portfolio. I'll just explain that with an example. Yeah. So here we have the example of a normal SIP. What happens? Let's say if you decide to invest in three funds, fund A, B, and C, right? And you said that I'll do $60 in fund A, 30 in fund B, and 10% in fund C. And you allocate that money. But obviously, because of market movement, some of the funds will have will the allocation will go up. Some of the funds allocation will go down purely because of NAV movement. Some moving faster, some moving slower. After the drift, let's say this 60% allocation became 57. The fund B from 30 it became 32, and fund C from 10 it became 11. Now you are drifted from the actual uh, what do you say, the targeted allocation. Now, if you have an SIP of 10 rupees going in, again, what it will do is it will again simply put money in that proportion. So six rupees will go in fund A, three in fund B, and one in fund C. And after SIP also, your uh, target portfolio allocation will be not met. Instead, what you could have done was put more in fund A because it has fallen in value. So let's say a smart SIP would put 9 rupees in fund A, 1 rupee in fund B, and nothing in fund C. By that way, after SIP, you will again achieve your target allocation, which was 60/30/10.
So, I mean, this is great. I mean, this looks great in theory, but in practice, we've not really seen any major fund house or a broker that allows you to do this. So, how would an investor actually realize this sort of a setup?
So yeah, that is correct, Kushal, that if you set an SIP, the amounts cannot be dynamic, right? You have to just keep on following that amount. But at Deserve, what we are doing is we are asking the investor to do an SIP in our strategies so that we can allocate it every month into these different strategies as per the target allocation. So if an investor does an SIP with us, this smart SIP is the method is what we follow and allocate it such that the portfolio gets rebalanced automatically with every SIP installment coming in.
Understood. If you could also maybe touch upon how this helps in realigning the portfolio without realizing too much tax or too many redemptions, it would help the audience understand how an SIP is far more tax efficient than maybe just putting in a lump sum and rebalancing.
So, sorry. So, let's say if this person over here in the previous example, the normal SIP, had to bring the allocation back to 60/30/10, they would have to sell some part of their fund B, right? In fact, instead of selling, they ended up buying more. And that will create a tax event if you want to. And you pay out taxes every time you sell your mutual funds. While that is okay, but you have to be sure that the taxes that I'm paying out will take me towards my target portfolio and help me generate better returns than what I'm making right now. So that's where SIP comes into play. And here you will see that without any kind of sell transaction or tinkering with the existing allocation, you manage to rebalance it just through a cash flow.
Understood. Got it. That was great, Pratik. Really insightful. We have a bunch of questions. I would like to take a few of those now. Uh,
Sure.
so just fundamentally speaking, we have a few questions on how one can balance both SIP and SWP
Yeah.
and ensure that they get the maximum benefit out of it.
Mm, okay, so SWP, I'm assuming that this is for the consumption purpose. For example, somebody who is retired and they want an income every month, or and that's why they are doing SWP. SWP just for moving out of one fund and getting into other might not be a great idea. So that the redemptions have to be done very dynamically, and you need to uh, look at the transactions that you have done in the past and match it accordingly. Also, you need to see that okay, the past transactions now where you are moving that money. Only if it is fruitful, then you move it into the new fund.
Got it. How would this look in context of someone who's retired, right?
Ideally, if you are doing an SIP, right, even if you are retired, you should
Yeah.
not be doing SWP, because one hand you are giving the mutual fund money and the other hand you are just withdrawing from that. Rather, just stop doing the SIP and use it for whatever purpose you are doing the SWP.
Understood. Got it. Also, in the example that you touched upon with Axis Focus and how switching had a better outcome, in that example, was it a case where Axis Focus, the funds allocated to Axis Focus were left to grow there and we moved new proceeds to the new fund, or did we redeem and reinvest?
Sorry, you'll have to come again on that.
So in the example of Axis Focused,
Yeah,
where we switch from Axis to HDFC,
correct.
did we leave what was already invested in Axis Focused, or did we just move the whole amount?
No, we completely moved. So whatever we were holding, we sold that and bought HDFC Flexi, plus all the SIPs also that were going into future SIPs that were also stopped and shifted to HDFC Flexi.
Got it. So a follow-up question here is, A, what sort of tax impact would it have? And would it be meaningful enough to offset the additional gains? And B, we have a question around compounding. Would this not affect compounding if we keep switching?
See, compounding is not breaking because you are not taking out the money and using it, right? The
Right.
money is still in the market, but instead of fund manager A, now it is with fund manager B. And fund manager B is expected to do better than fund manager A. That's the reason you've made the switch. That's the hypothesis that we are working with, right? So if the fund manager B is going to do better, how does the compounding break, right? It's just a transaction that you've done, but still you continue to accrue the benefits of, yeah, it will incur a tax event. Let's say in the example that we used, we had an investment of around 15 lakhs plus the portfolio grew to 30 lakhs or even a 10% tax break. We didn't even have 10-12% taxation by then, right? You will get
Right.
grandfathering on some, etc. Let's assume even if you pay 10% taxation flat on the entire gain, the difference that was made by switching to HDFC Flexi was to the tune of 25 to 32 lakhs, right? It could have more than covered up for the taxation that you paid for.
Understood. Understood. We have a bunch of questions on how we actually select funds, right? It's easy to say that we can switch from one fund to another, but
Yeah.
how do we look at past trends or other estimate in the current macro environment, given how a certain fund is set up, which one is poised to do better than the rest?
Between a lump sum and an SIP, you are asking?
No. Selection. Like, how do we at Deserve look at fund selection? What sort of macro variables do we look at?
Oh, so I'll just, while I touched upon it briefly, I'll again. do that a little bit more in detail. So we don't look at performance, we look at five things in a mutual fund. The first thing that we look at is fundamentals. By fundamentals, I mean how is the portfolio constructed? What is the PE of the underlying companies? What is the PB of the underlying companies? Basically the valuation ratios. Then within the same fundamentals, we look at the growth, potential growth, historical growth of those companies. What rate are they growing their revenues? What is the pace at which they are growing their earnings, past and future expectations of growth, both. So more or less, this valuation and growth bucket, we understand the fundamentals of the holdings of this mutual fund. That is one part. Second, we look at how is the money allocated across various segments of the market. Right. For example, are they overweight on IT sector? Are they underweight on banking sector? Those are the things you look at. You also look at the style bias. So are they more growth oriented? Do they have more value style companies? So value style would be something which is available very low PE compared to growth style would be something which is growing at a very rapid speed. So what sort of a construct do they have in their portfolio? That is the second part, which is allocation.
Got it.
The third is the skill, as in, is the fund manager making money because they have a one-time gain, some bet that they took and it just did super well, or is it consistently they are able to pick good stocks, right? So somebody, if he has let's say just made money because of a theme, that will be shown in the portfolio, because when that theme did well, the portfolio did well, but otherwise the portfolio does not. But when there would be other fund manager that regardless of the theme, they have been able to pick good stocks and create a portfolio. So that is the skill part of it. And then finally, we have trend, which is macroeconomic trends. So the all the other things that we looked at, fundamentals, allocation, and the skill, we correlate that with macroeconomic trend. That within in a scenario where interest rates are rising, or GDP is rising very fast, or GDP is rising gradually, inflation is high or slow, high or low. In that sort of an environment, uh, which kind of a fundamental allocation and skill is expected to do better.
Understood.
That is what
Understood.
we are looking at.
Got it. That was super. Thanks, Prateek. Just before you go, one parting question. If investors remember just one SIP rule for the next 20 years, what should it be?
Be consistent at it. It's withdraw or stop an SIP only if there is a situation, and do not shy away from switching your SIPs. Right? A lot of people feel that if I've started this, I have to continue. It's a 20-year commitment, 30, nothing like that. If the fund is not performing well, not expected to perform well, you have to be vigilant and move to better performing funds.
Got it. Thanks. Thanks a lot, Prateek, for your time. Thank you, folks, for joining us here on a weekend, and we hope you found this session insightful. And before you go, you'd be faced with a feedback questionnaire. I kindly urge you all to please fill that out. It'll help us deliver better and more consistent content to you week on week. Thank you very much for your time.
Thank you, everyone. Thanks. Bye.